Hey guys, welcome back to the channel. In this video, I'll be giving an update on my dividend portfolio for the month of June. I'll go through which stocks paid me and show you how the passive income in this portfolio is growing over the last month. I'll also touch on some of the changes that I've made to my strategy since the last video, so make sure you stick around to see that. Now it's been a couple weeks since I last uploaded, and that's because I ended up moving to a new apartment. I'm excited to see what improvements I can make to the channel now that I have more space, and one of those improvements is actually filming video and not just sticking to voiceover. So once we hit 1,000 subscribers, I'll begin to make some of those changes to the videos, and I think it'll make the videos much more entertaining and allow for different ways of explaining complex ideas, so make sure you subscribe to the channel if you want to see that happen. Also, the last portfolio I did was not the most successful video on my channel, to say the least. And I don't really expect the updates to carry my channel because people don't search for portfolio update videos, but I'm hoping that these videos will allow you guys to see how all the individual pieces of my investing strategy come together. Since these videos will be harder for others to find, make sure you like these videos in particular so YouTube recommends them to others. And before we jump into the account, let me first say that I'm not a financial advisor. All the information here is for educational purposes, so make sure to do your own research before making any investment decisions. With that said, let's get into the portfolio. As you guys can see now, the account has grown considerably since the update 2 months ago. We are now at a total portfolio value of $3,579 since we started investing in February of this year, which goes to show that consistent investing every week pays off even when the market is falling. In the last 5 months, we've had gains of $294, of which $26 are earned dividends. Now this doesn't sound like much because it really isn't a lot of money right now. However, the goal of this portfolio is to grow the passive income that I receive from these companies, and we all have to start somewhere. So in the month of June, I had 4 different companies and 2 different funds pay me dividends. On July 4th, I received 2 payments, both of which are from my bond funds. What's nice about these funds is they will pay out money every single month, and even though it's very small amounts right now, consistent cash flow can be very valuable. The next day, on June 5th, I received a $2.88 dividend from Pfizer, which made up a large portion of this month's cash flow. Something to keep in mind with this is the payment frequency. Some companies like Realty Income Corp, which I did an analysis on that you should check out, pay dividends every single month, but others like Pfizer pay quarterly or every 3 months. So when quarterly dividend payers do pay out, it's much larger but less frequent than monthly dividend payers. On June 15th, I received 26 cents from NextEra Energy, then 59 cents from Raytheon Technologies on the 18th, and 69 cents from Waste Management to finish off the month. All of this combines to a total monthly income of $4.93, which still doesn't sound like a lot because it isn't. But if you look at the graph on screen now, you can see how I track my passive income, which that little line in the back is what I focus on. The monthly income in June was about 9% higher than the income in May, which is a really good growth rate. Over time, this amount will grow, and the income generated by these investments will become a significant source of income over the next 10, 20, 30, even 40 years. So, now let's jump into the portfolio composition, where we'll break down what industries I invest in and the weightings between those, and then dive a little bit deeper into the individual companies that I'm invested in each industry. Now, the industry that I hold the most money in right now is real estate, where my target allocation is set at 25%. Now, the reason that I'm so heavy in real estate right now are the facts that I think they're cheap relative to general market because they haven't had quite the bounce back like the other industries, and I don't own any real estate outside of the public markets. In the next couple years, I could see myself investing in real estate, but for the time being, I still want the diversification that comes with owning different asset classes, and REITs are a good way for me to get some of that benefit right now. Next up, I have 15% of my target allocation in financials, and a large reason is how undervalued I think the entire industry has been for years, especially in the last few months. Then we have healthcare at 14% due to the safety that they tend to bring during recessions. And then I have consumer and industrial set at 11% each. Then bond funds at 10%, and energy and utilities set at 6%. So diving into these industries to see what changes I've made in the time since our last update, in my real estate pie, I've really diversified and shifted around my target allocations. I now have Realty Income Corp as my largest target allocation at 40%, because I am blown away by how stable and safe the company's tenants and business model is. They're one of my favorite stocks out there, and actually one of my favorite videos that I've also made as well. So on a side note, almost all the stocks in my portfolio I have made individual, more detailed videos on, so check that out if any of them are interesting to you. The rest of my real estate portfolio is comprised of Toll Brothers, W.P. Carey, and Simon Property Group. W.P. Carey is basically a slightly riskier Realty Income Corp. So I like holding them for the higher potential upside, but I'm also protecting myself on the downside by holding a smaller weighting of them. Also, Toll Brothers is different from the rest of these companies because they're not a REIT. They're a home building stock, and that gives an additional degree of diversification to my real estate portfolio. And finally, Simon Property Group is by far the riskiest investment in real estate for me, but I only have them at a target allocation of 15%, so my risk is limited to that amount, but I also think they're very undervalued, and the mall business model that they rely on is not going anywhere in the near term. Next up, we have financials, which I only hold 2 companies in. The majority of my financial stock, 80% of it, is held in JP Morgan Chase, because I feel like they're one of the safest and best run large banks out there. However, a new addition since the last update is Berkshire Hathaway. I have them targeted to be only 20% for 2 different reasons. They aren't exactly what I would classify as a traditional financials company, but it's probably the best fit, even though it's not great. But 2, they don't pay a dividend, and for as long as Warren Buffett and Charlie Munger are at the head of the company, I don't foresee them starting this. However, I could see that in the next 10 to 15 years that they do start to pay a dividend. And if they do, it will probably be one of the safest dividends available due to their crazy diversification and their focus on steady, cash flow producing companies. However, I'm also looking for one additional company to add to my financials industry. So if you guys have any suggestions, make sure to let me know in the comments below. At 14% of my portfolio, I have healthcare, which is comprised of 2 stocks, Johnson & Johnson and Pfizer. At 60%, Pfizer is the largest of the 2 holdings. However, I'm looking to reduce this with the addition of another pharmaceutical company, but I'm not willing to commit to one until I've done all the research necessary. So again, if you guys have anything I should look into, please let me know. This isn't to say that Pfizer is a bad company. It just means that pharmaceutical companies like Pfizer carry more risk than other companies like Johnson & Johnson, who can rely on solid branding instead of the ever-changing regulatory environment set around patents. And then at 40%, as I just mentioned, I have Johnson & Johnson, which is an incredibly safe and consistent investment than it has been for decades. Next, at 11%, I have the consumers industry, which is made up of Target Corp and Disney. I don't believe that Target was in my previous update, and I recently did a video on them, which goes into why it makes up 60% of my consumer pie. And one of my first analyses on this channel was Disney stock. And although it's still a good investment, I'm not nearly as bullish on the stock right now as I was back then. In the last couple months, they've suspended their dividend, which isn't the end of the world, but this pandemic has really made me realize how dependent Disney is on discretionary spending. Their main business units depend on people going to the movies, going on vacation, and although their streaming service is helping them right now, I think overall the business is hurting more than people realize. As in healthcare and financials, I'm also looking for one more good stock in this industry to reduce some of my exposure to Disney, so let me know. Next up, industrials make up 11% of my portfolio. There isn't a ton to say about these positions that I didn't mention in their analyses videos, but Waste Management and Raytheon are both incredibly solid companies, and I'll be happy to hold these into the foreseeable future. Like industrials, there isn't a ton to talk about when it comes to my bond positions either. I hold 60% in long-term government bonds because I already have a lot of exposure to corporate well-being through my stock positions. And the other 40% is held in emerging markets, which gives me some exposure outside of the United States, since the majority of this portfolio is made up of American companies.
At 8% of my portfolio, I have tech, which is comprised of Facebook, AT&T, and Microsoft. The largest allocation is for AT&T because they pay a substantial dividend and have a strong moat around their core business model. Facebook and Microsoft are both set at 30%, and although they both bring down the dividend yield in this slice, I think it's worth it because of their future potential dividends.
And last, energy and utilities makes up 6% of my target allocation for this portfolio. I don't believe I've done analysis videos on any of these stocks, so make sure to subscribe if you don't want to. So make sure you subscribe to the channel if you want to see them when I release those videos. But in this portfolio, 60% is NextEra, a leading energy company with a decent amount of exposure to clean energy. 20% is Canadian Solar, which is a company that manufactures high-end solar panels. And the other 20% is Renewable Energy Group, who provides renewable energy and is the leader in biofuels in America. That wraps up my portfolio at the current time. I think it's important to point out that even though I made a lot of adjustments to my target allocations, I have not sold a single share of any of these companies. That doesn't mean I won't be in the future, because I'm sure there are some cases where the business model will change, the value that I once saw doesn't materialize, or another reason why I don't feel comfortable investing in a company. And if that happens, I will definitely sell the stock. But that decision does not come lightly. It's probably a good indicator that you don't do enough research before you buy a stock if you commonly sell out of the stock quickly after you bought it. But with that said, it's also important to be able to admit you were wrong on an investment and cut your losses before any more happen. And that's the difficult part to investing. It's being able to recognize when you were wrong and separate yourself from your emotions that are driven by the market. I hope you guys enjoyed the video. And if you did, I would love it if you could show your support by liking the video, sharing it with your friends or family, and subscribing to the channel if you haven't done that already. I will see you guys next weekend for another stock analysis video.